Hi. So I decided I was going to cover these weekly updates in three ways. Firstly, we're going to cover off on the virus pandemic. Secondly, we're going to look at the economic changes as they're impacting the economies. And thirdly, we're going to look at the market response to those changes in central bank and government action. So firstly, on the pandemic, it's quite clear that the lockdown is having an effect. So where people are doing a proper lockdown, you can see the curves flattening off quite dramatically. And that's exactly what we need to see because that's what pushes the number of beds on need for healthcare systems back, decreases demand for ventilators, and means that potentially we can weather the storm. The problem is a number of countries are not locking down, most notably the US, and you can see that actually their numbers are the worst of any economy in the world right now. As I mentioned last week, there's a choice that governments need to make, and that's about crushing the economy or letting lives go. And ultimately, what you try and do is you crush the economy, or what you have to do is crush the economy, because then you're saving lives, and that's ultimately what government's mandate is. Um, but you question what the US is doing now because they're not moving to full lockdown. And even, I mean, I think they've got a fifth of their population in lockdown, and Trump is talking about actually rolling some of that back in the next few weeks. Well, that's exactly the wrong situation because you can see their numbers are getting materially worse. So the economic data we're seeing are absolutely terrible, and that's across the globe. We could be looking at unemployment rates of 25% up to 50% in some economies. We could see GDP falling 25 to 50% in Q2 or Q3. Everyone's expecting strong bounce backs in the latter half of the year, but I really get worried about what happens if we don't see those bounce backs. And actually, what we see is an L-shaped recovery or a very, very drawn out, slow recovery, which is in contrast to the strong bounce that everyone else is expecting. So, since last week's video, we've seen numerous actions by the authorities. We saw increased quantitative easing by the US government, and we saw massive quantitative easing coming out of the RBNZ in New Zealand. I've also seen the huge fiscal packages coming out in the US, which, depending on market reports, whichever market you're reading, could be somewhere between 2 trillion and 4 trillion, but there's a massive degree in leverage that can be employed. So it's very difficult to actually get a handle. But we know they're trying to backstop a number of the businesses from going under. And that's really what these packages are aiming to do. They're trying to stop small businesses going down. Because the problem is, most of the economy, well, over 50% of the economy in the US and well over 50% of job openings in the US come from small companies, and their companies employ less than 50 people. So if that sector dies out, which is very clearly at risk of doing so, when we get on top of the pandemic and the fiscal pulse begins to move the economy, you'll have no impact because there's nothing left to stimulate. So the focus of governments very clearly across the world is to try and support the small business sector. So when the bounce back has the ability to happen, it actually is able to be seen in the economic data. So we have this clear policy by central banks to drive bond yields across the world to zero and to hold them there. And you can expect they're not going to be hiking rates for many, many years. And that's why if you're able to buy US 2 years around 30 basis points, that pretty much looks a very good deal because you know they're going to trade to virtually zero and just stay there forever. So there's 30 basis points you can make there. You can be long, Aussie threes, because you know the RBA is backstopping you at 25 basis points. So if you're buying any level above that, it's a good trade. And arguably they'll trade through that 25 basis point level. And then ultimately curves will pancake across the world and all bond yields will be heading to zero. So we've got that by central banks. But then on the other side, we've got this massive fiscal policy that's coming out across the world. And they're trying to backstop the economy by supporting the smaller companies and making sure that we can bounce back. That's the key thing to be aware of here. So now let's move over to markets and see how markets are taking these changes. Well, firstly, we've seen a very strong rally in bond yields. Obviously, on the first part of this down move we saw in equities, we saw bond yields rally massively. We saw 10-year treasuries bottom out of just under 40 basis points. They backed up to 115. They've rallied since then quite materially. And right now, 10-year treasuries are about 78 basis points. They should head towards zero sometime over the next 6 months to a year as well. So again, being long bonds is a key way we're positioning in these markets. Obviously, we saw the US package just trying to support investment grade credit, and they're flooding the system with liquidity. They're supporting investment grade credit out to 4 years, effectively, not loan forgiveness, but loan holidays, these kind of things. I just want to be quite clear here. They've bought the market time, but there is a big difference between impacting solvency and impacting liquidity. It's quite clear that liquidity issues that were very, very prevalent in the market have been largely dealt with by the packages the Fed's done. But all the Fed's done is address the liquidity issues. They haven't addressed the solvency issues, which come with a number of these companies. And the reason they have solvency issues, they massively geared up their balance sheet over the last few years. And so we've seen this bounce in investment grade credit. High yield is bounced in sympathy with it, but still looks like it could sell off. And EM still looks a little bit worrisome to us. So we're still sitting more on the nervous side. We're defensively positioned here. We do acknowledge the fact that the markets are oversold, and with the amount of ammunition that's been thrown at them by governments and central banks, there is a high likelihood we get a bit of a bounce, certainly into month end, as a large-scale rebalancing is going to happen. But on a 3 to 6 month view, we're still nervous about the valuation of risk assets, and we like being long bonds here.